There's a habit worth building if you want to actually understand your own finances instead of just feeling anxious about them whenever a big, scary sounding headline crosses your feed. Stop and ask what it would look like in the one place you can check for yourself, which is your own grocery receipt. That's what this video is going to do. We're going to start with something small and personal, your grocery bill, and follow the thread all the way out to decisions being made inside national treasuries and central banks, using only numbers that are already published and free for anyone to look up. Let's start with your grocery bill, because that's the part of this story you actually feel. In the 12 months ending in May 2026, the government's official measure of prices, called the Consumer Price Index, rose 4.2%. That's the biggest one-year jump since April 2023. Food overall was up 3.1%. Groceries specifically, the food you buy at the store rather than at a restaurant, were up 2.7%. That might not sound huge on its own, but energy prices were up 23.5% over that same year. And energy touches almost everything because it costs money to grow food, truck it, refrigerate it, and put it on a shelf. When the cost of running the truck goes up 23%, some of that cost eventually shows up in the price of the bread on the truck. On top of that, shelter costs, meaning rent, and the cost of owning a home, rose 3.4% over the same 12 months, which matters here because rent is usually the single largest line item in most households' monthly budget, larger than groceries by a wide margin. When rent, energy, and groceries are all rising at the same time, even moderately, the combined squeeze on a monthly paycheck is bigger than any single number in isolation would suggest. Here's the thing that a lot of people miss. The official number and the number in your head are usually different, and that gap isn't your imagination. Surveys done in 2025 found that ordinary people estimated grocery inflation at around 4% for the year, while the official figure for that period was closer to 7%. That's not because people are bad at math. It's because a small number of items, the ones you buy every single week, move a lot more than the average. Fresh tomatoes, for example, were up 32% in the year ending May 2026. Beef at the farm level was up nearly 17%. Coffee and other beverages were up close to 6%. Meanwhile, some items, like eggs, actually got cheaper after the shortages of the past few years eased. An average blends the tomatoes and the eggs together and hands you a tame-sounding number, even though your own basket, if you buy a lot of beef and coffee and not many eggs, can feel a lot rougher. So that's the wallet-level story. Now let's zoom out, because the grocery bill is really just the visible tip of a much bigger and slower-moving story about money itself, and that story is what this video is actually about. Every currency in the world is a promise. When a government issues money, it's making an implicit promise that the paper, or the digits in your account, will keep buying roughly the same amount of stuff over time. That promise gets tested constantly, and it gets weaker whenever a government spends more than it collects and covers the difference by creating more currency or by simply carrying more and more debt. As of early 2026, the U.S. federal government owes more than $36 trillion, and it is adding somewhere between 1.8 and $2 trillion a year in new deficit spending. To be clear, this is not a prediction of collapse, and the United States has never defaulted on its debt, but this is the kind of arithmetic that professional money managers, the people whose entire job is managing national savings, pay very close attention to, because it shapes how much a dollar today is worth compared to a dollar 10 years from now. And here's where the story connects to something you may have already noticed in the news: gold. Not gold as a shiny metal people wear, but gold as something that national governments themselves are buying in enormous quantities, using public money on purpose. According to the World Gold Council, central banks around the world bought 863 tons of gold in 2025. That's down slightly from the previous 3 years, each of which saw purchases above 10,000 tons, but it's still roughly double the average pace these institutions kept up through most of the 2010s, when the yearly number was closer to 400 or 500 tons. And the official number likely understates what's really happening because central banks aren't required to report their gold purchases to the International Monetary Fund in real time. Independent estimates, built from trade flows and refinery data, rather than official statements, put actual buying in the first quarter of 2026 at around 244 tons, which would put the full year on pace to land somewhere between 700 and 900 tons, even in a slow year. Who's doing the buying matters as much as how much. Poland has been the single largest buyer for 2 years, running adding around 100 tons in 2025 alone and pushing gold to 28% of its total reserves, with its central bank governor publicly stating he wants to eventually reach 700 tons. Kazakhstan had its highest year of gold buying on record going back to 1993. Brazil's central bank came back into the gold market in 2025 after staying out since 2021. And China is the biggest question mark of all. The People's Bank of China stopped publicly reporting its gold purchases in most of its foreign exchange filings, even while Chinese customs data shows net gold imports into the country running close to 300 tons in a single quarter of 2026. Most independent analysts believe China's actual reserve buying is significantly higher than what shows up in the official numbers. Why would dozens of national governments sitting on trillions of dollars in reserves choose to convert some of that into a metal that pays no interest and costs money to store? The answer that shows up again and again in surveys of the people who actually run these reserves is not about chasing a trade. It's about sovereignty. In the World Gold Council's most recent survey of central bank reserve managers, the largest survey of its kind ever conducted, a record 45% said they expect their own institution to add more gold in the next 12 months, and 89% believe total central bank gold holdings worldwide will keep rising. Look out 5 years, and 84% expect gold to make up a bigger share of total reserves than it does today. There's a specific event a lot of these reserve managers point to when explaining why. In 2022, in response to the invasion of Ukraine, Western governments froze roughly $300 billion of Russia's foreign currency reserves. For decades, the working assumption among central banks was that holding dollars, euros, or government bonds for major economies was close to the safest thing a country could do with its savings. That freeze changed the calculation overnight for a lot of finance ministries around the world because it demonstrated that money held in another country's currency can be switched off by that country's government. Gold, physically stored inside your own borders, cannot be frozen by a foreign government or erased by someone else's sanctions list. That is the entire appeal in one sentence. It is the one reserve asset that cannot be switched off remotely. This is not a new idea in history. It's actually one of the oldest patterns there is, and looking at a couple of past examples helps explain why so many institutions are behaving this way today without anyone needing to predict a specific date or a specific crisis. Go back to 1971. Until that year, the US dollar was directly convertible into gold at a fixed rate, and the rest of the world's currencies were pegged to the dollar under a system called Bretton Woods. In August 1971, President Nixon ended that convertibility because the US no longer had enough gold to back all the dollars that had been printed and that foreign governments were holding. The dollar was cut loose to float freely. In the decade that followed, Prices in the United States roughly doubled, while the price of gold rose more than 20-fold. People who held only cash and bonds through the 1970s watched their purchasing power erode steadily, even as the numbers in their bank accounts stayed the same or grew a little. People who held real assets, including gold, came through that decade with their buying power largely intact. The lesson from that period wasn't that gold always wins. It was that when a currency's old anchor is removed, the adjustment period can be long, uneven, and much harder on savers than on people who own real, tangible things. It's worth stepping back even further than that, because this pattern of a dominant currency eventually losing its dominance is not a 20th century invention. In the 1600s, the Dutch Republic sat at the center of world trade and finance, running the first true global reserve currency system through the Bank of Amsterdam and the Dutch East India Company. Over the following century, as Dutch merchants took on more debt to finance wars, and as rival powers, first France, then Britain, built stronger navies and stronger public finances, Amsterdam's central role faded slowly over generations, not overnight. Nobody living through the early 1700s in Amsterdam would have described a single collapse. What they would have described if you'd asked them was money that didn't stretch quite as far each year, opportunities that increasingly went to London instead of home, and a growing sense that the old certainties about Dutch financial supremacy no longer applied the way they once had. That's the pattern worth remembering. Reserve currency transitions in history have almost never looked like a single dramatic headline. They've looked like a slow erosion that's obvious in hindsight and easy to miss while it's happening. You don't actually have to go back decades to find the most relevant example, though, because most adults watching this lived through it personally. In 2021 and 2022, U.S. inflation spiked to 1% at its peak, the highest reading in roughly 40 years, driven by a mix of pandemic-era government spending, supply chain breakdowns, and a surge in energy prices after Russia's invasion of Ukraine disrupted global oil and gas markets. Grocery prices during that stretch rose especially fast, with the food at home index climbing 8% in 2022 alone, the kind of year where the cost of a full cart at the grocery store visibly changed from one month to the next. The Federal Reserve responded by raising interest rates at one of the fastest paces in its history, which eventually did bring inflation back down, but not before it reshaped how an entire generation of consumers thought about prices. That episode is useful precisely because it's recent and personally memorable. It shows that a currency's purchasing power can erode meaningfully within a couple of years, not just across a multi-decade cycle, and that the psychological effects, people's expectations about future prices, can outlast the official numbers by years. Recall that survey from earlier in this video, where ordinary consumers estimated 2025 grocery inflation at 4%, while the official number was 7%. That gap is very likely an after effect of the 2022 shock still lingering in people's expectations, even after the official data cooled down. The 2008 financial crisis offers a more recent and more familiar example of a different kind of lesson. Certainty itself can be the danger. In the years leading up to 2008, the dominant belief among both everyday homeowners and highly trained professionals at the largest banks in the world was that U.S. housing prices, taken as a nationwide average, simply did not fall. That belief was treated as close to a law of nature, and enormous amounts of borrowed money were built on top of it. When home prices did fall nationwide for the first time in the modern data, the assumption underneath trillions of dollars in mortgage-backed securities turned out to be wrong all at once. And the result was the worst financial crisis since the Great Depression. The lesson from 2008 isn't about housing specifically. It's that the moment something is treated as impossible by nearly everyone, including the experts, is often exactly the moment it deserves the closest scrutiny. Or, go back further to Weimar Germany in 1923. That's the most extreme example anyone ever points to. And it's extreme for a reason. It shows what happens at the far end of the spectrum when a government finances its spending entirely by printing money. German prices didn't just rise, they rose so fast that workers were paid twice a day because the value of their wages could fall by half before lunch. People with real assets, farmland, factories, foreign currency, or gold kept something. People whose entire net worth sat in German mark savings accounts and government bonds lost essentially everything. Nobody serious is arguing that the United States or any major economy today is on that path. The reason this example gets used isn't as a prediction, it's as a boundary marker, the extreme case that shows what currency risk looks like when it's taken to its logical end. There's a third example that's smaller in scale but useful because it shows this can happen to a powerful, respected currency, not just a broken one. In 1956, during the Suez Crisis, Britain and France invaded Egypt to try to retake control of the Suez Canal. The United States, disapproving of the move, threatened to sell British government bonds and refused to support the pound, which was already under pressure. Britain was forced into a humiliating retreat within days, and the episode is widely seen by historians as the moment the pound sterling's status as the world's dominant reserve currency effectively ended, even though the pound had held that position for well over a century before that. The lesson historians draw from Suez is that reserve currency status isn't permanent and isn't only decided by economic fundamentals. It can shift because of a single political decision, and once confidence starts to erode, it can erode quickly. None of this means the dollar is about to lose its role, the way the pound eventually did, and nobody credible is putting a date on anything like that. But you can see why central bankers whose entire professional training is built around studying exactly these historical episodes would look at rising government debt, a currency that has been used as a political weapon through sanctions, and a live memory of what happened to previous reserve currencies, and quietly decide to hold a bit more of an asset that sits outside any single government's control. There's one more piece of the puzzle worth putting on the table because it's the flip side of the gold story. And it's happening in the same stock market many people hold inside their retirement accounts without thinking twice about it. A commonly used measure of how expensive the USS stock market is, called the Shiller-Cape ratio, looks at today's stock prices compared to the average, inflation-adjusted earnings of the companies in the index over the past 10 years. That measure has averaged around 16 to 17 across nearly a century and a half of data. As of mid-2026, it sits above 41. The only other time in recorded history it reached that level was during the dot-com bubble of 1999 and 2000, right before the S&P 500 lost close to 77% of its value over the following 2 years. To be fair, some analysts argue this time is genuinely different, pointing to real, substantial earnings growth coming from artificial intelligence companies rather than the revenue-free startups of the late 1990s. That's a real, ongoing debate among professional investors, not a settled fact, and history has shown that markets can stay expensive for a long time before anything changes. But the plain language version of what a ratio like this tells you is simple. Right now, buyers are paying roughly 2.5 times the historical average price for every dollar a company earns. That doesn't tell you what happens next. It tells you that the cushion for absorbing bad news is thinner today than it has been through most of market history, which is a fact worth knowing whether or not it changes anything about your own plan. So let's bring this back down to the everyday, because that's really the point of this whole video. Gold hit an all-time high of $5,089 an ounce on January 28, 2026, before pulling back to somewhere around $4,300 to $4,000 by the middle of the year. That's still roughly triple where gold traded just a few years earlier. Major bank research desks have published a range of forecasts for where it goes next, with some projecting prices near $6,000 by the end of 2026, and others expecting a more moderate sideways path. Forecasts like these are exactly that, forecasts, not guarantees, and the range between different banks' predictions tells you how much uncertainty is genuinely in the system right now. Meanwhile, your grocery bill, your rent, and your utility bill are being driven by a different but related mechanism. When energy costs rise 23.5% in a year, when shelter costs rise over 3%, and when the government continues running deficits in the trillions, the value of money sitting still in a low-interest savings account is being quietly worn down. If your savings account pays you 4% a year in interest, and the true cost of the things you actually buy is rising faster than that in the categories that matter most to you, the number in your account goes up, while what it can buy does not keep pace. That's the whole mechanism, in plain language, the gap between what your money earns sitting still and what the world you buy from actually costs. I want to be honest that this is not a story about impending disaster. The United States has never defaulted on its debt. The dollar remains by far the most used currency in global trade, and the vast majority of professional forecasters are not calling for anything like the Weimar scenario. What's happening instead is a slower, more structural shift, visible mainly in the behavior of the institutions that manage the most money in the world, not in any single headline. Gold now makes up a larger share of central bank reserves than U.S. Treasury bonds for the first time since 1996, according to research published by Morgan Stanley. That's a meaningful marker, even if it's not a dramatic one. So what does an ordinary person, without access to a sovereign wealth fund or a research department, actually do with this information? I want to be careful here because I'm not a licensed advisor and this isn't a recommendation. But I can describe factually the tools that exist for the concerns we've just walked through, and you can take that information to a professional who knows your specific situation. If your concern is that a portion of your savings is losing purchasing power to inflation, there are Treasury inflation protected securities, commonly called TIPS, which are U.S. government bonds specifically designed so that their principal value rises with the official Consumer Price Index. There are also Series 1 savings bonds, sold directly by the U.S. Treasury, which combine a fixed rate with an inflation-adjusted rate that resets twice a year. Both exist for exactly the problem we just described, cash that sits still while prices don't. Neither pays especially high returns compared to riskier assets over long stretches of history, and that's the trade-off by design. They are built to preserve purchasing power, not to grow it dramatically, and understanding that trade-off up front is part of deciding whether they fit your own goals. The broader concept underneath most of what professional portfolio managers actually do, once you strip away the jargon, is diversification. Not putting all of your savings into one type of asset, one country, or one currency, so that no single event can affect everything you own at the same time. This is the same logic, scaled down, that drives a central bank to hold some reserves in dollars, some in euros, some in gold, and some in other government bonds rather than everything in one basket. It's also why a financial advisor might suggest a mix across stocks, bonds, cash, and sometimes a small allocation to alternative assets like gold or real estate, rather than concentrating everything in whichever asset happened to perform best over the last 5 years. Diversification doesn't promise higher returns. What it does is reduce the odds that a single piece of bad news, whether it's a currency event, a market correction, or a shock to one industry, wipes out your entire plan at once. If your concern is exposure to any single currency or any single country's economic policy, there are diversified international index funds that spread savings across many countries' stock markets rather than concentrating everything in one economy. This doesn't eliminate risk, but it's a standard, well understood way that professional portfolio managers address the concern that one government's decisions might not be the only decisions affecting your savings. And if your interest, after everything we've discussed, is in the same asset that central banks have been accumulating, gold is available to individual investors in a few standard, non exotic forms. Gold backed exchange traded funds trade on ordinary stock exchanges and can be bought through any standard brokerage account, the same way you'd buy a stock. Physical gold, in coins or small bars, is another route, though it comes with storage and insurance considerations that an ETF doesn't. None of these are exotic financial instruments. They are the same categories of tools that show up in mainstream financial planning conversations, not some secret list. What I am not going to do is tell you a specific percentage of your savings to put anywhere. Anyone who tells you a confident, specific number without knowing your age, your debts, your income, your risk tolerance, and your time horizon is skipping the part of financial planning that actually matters most. A 25-year-old with no debt and a 30-year investing horizon has a completely different situation than someone 5 years from retirement. This is precisely the conversation to have with a licensed, fee only financial advisor, someone whose income doesn't depend on selling you a specific product. Let's close with the actual takeaway, because I think it's easy to get lost in the size of the numbers we've covered. Your grocery bill going up to 7% in a year while beef goes up 17% and tomatoes go up 32% is a real, felt kitchen table experience. Behind that experience is a much larger and slower story. A government carrying more than $36 trillion in debt. A currency whose old fixed relationship to gold ended more than 50 years ago. And a growing number of national governments quietly choosing to hold more of an asset that no other government can freeze or switch off. Neither of these facts, on their own, tells you what to do with your own money. But understanding the connection between them, the link between what shows up on your receipt and what's happening in the reserve vaults of national banks, is the kind of financial literacy that doesn't require predicting a collapse or naming a date. It just requires paying attention to numbers that are already public, already published, and already available to anyone who looks for them. One last thing worth saying plainly. Nothing in this video is telling you the sky is falling, and anyone who tells you they know exactly when a currency shift, a market correction, or an economic turning point will happen is telling you something they cannot actually know. What we can know, because it's published every month by government agencies and industry groups whose entire job is tracking this data, is where prices stand right now, how much central banks are buying of a given asset, and how today's market valuations compare to past periods in history. Those facts don't predict the future by themselves, but they're a far more solid foundation for a financial decision than a headline, a hunch, or a stranger on the internet promising certainty about something inherently uncertain. The single most useful skill in personal finance isn't picking the right asset. It's building the habit of checking primary sources, the Bureau of Labor Statistics, the World Gold Council, the Federal Reserve, before believing any specific claim about where the economy is headed. If you found this useful, the most helpful thing you can do is look up one number yourself this week. Check what your own bank is currently paying you in savings interest. and compare it to the most recent Consumer Price Index release from the Bureau of Labor Statistics. Write that gap in percentage points in the comments below. Just the number. That's the number that actually matters for your own situation, more than anything in the news.